This is Public Forum Debate. The 2021 November/December topic is Resolved: Increased United States federal regulation of cryptocurrency transactions and/or assets will produce more benefits than harms. Let's look to relevant definitions. Remember, in this resolution, we are talking about federal regulation. We are not arguing for or against state regulation, but rather for or against U.S. federal government regulation. Also, the definition of cryptocurrencies is a digital currency in which transactions are verified and records are maintained by a decentralized system rather than by a centralized authority. Blockchain is essentially how cryptocurrency is traded. It uses distributed ledger technology. Essentially, cryptocurrency transactions are a digital payment system. They don't rely on banks to verify transactions, and they are a peer-to-peer system that allows anyone anywhere to send and receive payments. Cryptocurrency assets are intangible digital currencies. There are a few pros to cryptocurrency. First, they can help bank the unbanked. Essentially, people without bank accounts can use cryptocurrencies to trade internationally. Second, cryptocurrency provides a method of privacy, unlike fiat currencies in some situations. Third, in terms of the economics, cryptocurrency provides lower fees generally, stability in highly unstable economies, and lower exchange rates. The cons of cryptocurrency are 1. Crime and terrorism. They can more easily get funding. 2. Software power necessary is extremely high, which contributes to climate change. And 3. The dollar hegemony of the United States becomes unstable. There are a few notable agencies, the first of which is the SEC, which views cryptocurrencies as securities. They are obligated to report realized gains and losses from cryptocurrency investments, and they mandate this to people to report these investments on their annual tax forms. The CFTC, or Commodities Futures Trading Commission, has classified Bitcoin and Ethereum as commodities. There's also an act known as the Bank Secrecy Act, which holds that crypto exchanges must implement anti-money laundering and know your customer programs. They also want regulators and crypto exchanges to report pertinent information to the Financial Crimes Enforcement Network. Finally, there is the IRS, which holds that and has vowed to crack down on crypto tax dodgers. The Federal Reserve, however, does not oversee regulatory enforcement of the cryptocurrency industry. Now let's look to Biden's stance on cryptocurrency. Biden has overall appointed people who are crypto skeptics. For example, the Office of the Comptroller of the Currency leader, Omarov, is a crypto skeptic. Moreover, Janet Yellen, the Treasury Department Secretary, has said on numerous occasions that cryptocurrency firms are inadequately regulated. The SEC Chairman Gary Gensler also agrees with this. The first article we look to is from the New York University Dispatch. They hold there are a few cons to not regulating cryptocurrency. 1. Transactions cannot be reversed or counterfeited. 2. With online Go URL platforms, users retain anonymity until they cash out or exchange their tokens. There are a few other cons here. Notably, the article also describes the biggest problem with current monetary policy is that the federal interest rates are arbitrarily issued and creditors have no interest in controlling the supply of money. This leads to volatility, high speculation, and many cryptocurrencies still face scalability issues. The second article describes a few other advantages to cryptocurrency regulation. The first of which is reducing scams, the second of which is attracting institutional money into the markets, and the third of which is giving the crypto market moral legitimacy. It also points to the disadvantages of cryptocurrency regulation, which is that it poses the risk of capital flight from crypto investors. The third article is from the American Bar Association in 2021, which argues for the regulation of digital currencies. It argues that unregulated digital asset activity can enable fraud and market abuse and can lead to losses for U.S. consumers. Moreover, many in the digital assets industry agree that there are gaps and ambiguities in the current regulatory regime that disadvantage U.S. companies compared to their foreign competitors. If regulation was done, it could not only protect customers and consumers, but also clarify these gaps and ambiguities in a way that will allow the U.S. digital assets industry to innovate and mature.